Looks like good news, 2 months of successive growth. Are we starting to see a trend here? Do you think it's a trend that could continue?
Well, the 2 months increase is definitely a very good sign for now. The problem is that it still doesn't shoot the lights out. We still see consumer price inflation at a lot higher levels, so 4.1 compared to a house price growth of 2.2. So we're still in negative growth in real terms. And most of the increase we attribute to the rate cutting cycle late last year. So the last rate cutting, the last 50 basis points came through in November, and that takes a while to filter through. So that's the biggest reason for the jump. Seasonal factors also play a bit of a role. So in summer months there's a little bit more demand in the house price in the general housing market, but mostly this highly credit-driven market is affected by the rates in such a way.
And of course, most of the analysts we've spoken to, including the Reserve Bank Governor herself, have indicated that the rate cuts we've seen over the past couple of years could be at an end, and we're more likely to see interest rate increases going forward. Do you think that could further depress demand going forward?
Yeah, I think that's definitely on our radar. This is a very credit-driven market. The household sector is very highly indebted at the moment, with debt to disposable income levels in the high 70s. So it's very sensitive to interest rate shocks, and we've seen that with the last interest rate hiking cycle, what it did to non-performing loans in banks and did to the general market, according to our estate agent surveys. If you look at measures like average time on the market or percentage of sellers you have to drop the asking prices. So there's a lot of negativity that comes with the interest rate hiking cycle, and unfortunately, like everybody else, we expect the CPI to start showing increases in the PPI later this year. So with another cycle of, say, 2.5 to 300 basis points later this year, it's definitely going to be some bad news for house prices once again.
I mean, you mentioned 250 to 300 basis points, but if it's a very gradual increase we're going to see in interest rates rather than a shock, do you think that homeowners will be able to absorb it?
Well, I think from the most recent history, it wasn't the house or the change in rate is usually about 50 basis points at a time. If you look at the debt to disposable income, we've taken very long to decrease it, and it hasn't decreased to levels or acceptable levels yet. So the decrease is sort of downwardly sticky, and I think a household sector, if you look at the global picture, doesn't usually pay off their debts that easy. We usually have to grow it out with inflation. So it's very difficult to reduce a level of debt, and not being able to reduce a level of debt before the next rate hiking cycle might get the homeowner into a difficult situation then.
How does this cycle compare with previous cycles that you've looked at historically?
Well, I think, Stephen, what's interesting about this, and what's so nice to be in the property sector over the last 10 years, to see this phenomenal experience is with the growth rates we've seen in 2004, 2005, the household sector managed to grow their credit extensively. So the structural change and the big interest rate drops from before, that type of credit growth and the type of boom that we saw in the South African market particularly, that's something that only comes around once a decade or once a century perhaps. It's not a normal rate hiking or a normal business cycle. And getting out of this major credit growth, that's a very big adjustment that we'll have to make in the way we manage our finances and the way that homeowners behave.
Now we talk about decreases in property prices and decreases in the real property price. Is there any fear that homeowners could sit with negative equity, such as you have seen in Spain and in the UK and the US indeed?
I think a negative equity is a real concern for us. I think there's currently a lot of negative equity going around. We see that a lot in our distressed portfolios. A lot of customers, for instance, or a lot of homeowners would be able to trade out of their properties, but they're not in a position to do so because of negative equity. I don't think the negative equity levels have reached exactly what they have in Spain, but hopefully we had a little bit more of a warning than some of the other more developed countries. So hopefully this warning would help the general household sector to understand that if we get another interest rate cut and the housing market still at the very low or very weak levels that it is now, negative equity can prohibit that and prohibit the liquidity in the market necessary to trade out of a property.
I suppose you also have to look at the decreases we're seeing in house prices at the moment against the massive surge we saw in house prices, particularly between 2004 and 2007, when we saw a huge increase in those prices.
Yes, I think the household sector treated the home as a primary asset and also as the only savings plan, including the retirement annuity, all included. That's not the case anymore. It is still a credit instrument. It's still something that attracts a huge interest. So there's a very big mindset change and a lot different way that consumers will have to look at their balance sheets going forward. This is a complete 360-degree turnaround from growing house prices that exceeds inflation and exceeds interest rates. So in 2004, 2005, you would make money by just holding onto property because your payment would be a lot less than your growth. That situation turned around 2007, 2008, that the same effect ate up all the profits, or a lot of the profits in the household sector. And we're still at a very low, very weak level where we pay very high interest rates compared to house price growth. So definitely a lot of backwards movement in normal balance sheets.
You also have the FNB Valuer's Market Strength Index, which tells you about supply and demand statistics. What are you seeing in those dynamics at the moment?
Yes, Stephen. The Valuer's Demand and Supply Index is a way that we try and quantify the demand and supply forces in the market. So every valuation that we do, we also values to rate demand and supply on a scale, and we subtract the two from each other. So if we look at them separately, we've seen supply started to increase very slightly over the last quarter, and demand dropping very slightly also again over the last quarter. So from a supply perspective, it could be that a lot of the sellers have waited for very long, kept their property off the market, and now got enough confidence to put it back on the market. But from a demand perspective, we really haven't seen any uptick in disposable income or people who wants to buy property at high levels. So that opens up the gap a little bit more. And that gap is way on the negative side, where we have massive oversupplies and very little demand feeding that. And that's also the main driver for the change in property prices. So even though we've seen the last 2 months picking up and a little bit of momentum in house prices, we really don't expect that to continue for too long.
What would your expectation be for the full year? What sorts of growth or decrease would you expect in nominal and in real terms?
Well, I think both of the pictures would look the same. There's the effect of the interest rates from last year November, which is almost 6 months ago, just under 6 months ago, has started to wear off. And with the demand and supply opening up, I think it's a fair assumption to make to say that there's a very real possibility of negative nominal house price inflation. From a real perspective, that's obviously completely the other way. With the outlook for CPI going up, the real prices will continue to decline even further.